Hello, welcome to the Economic View. I'm joined by Evan Lucas, our market strategist. Hi, Evan.
Hello, Tony. How are you?
Yeah, really good. Evan, let's talk about Jerome Powell, the man of the moment. He was speaking overnight, and we saw an immediate reaction on financial markets. What did he say, and what should we be doing about it?
Yeah, let's start the first part of that question. So let's have a look at the markets. The chart you've got on screen at the moment is clearly showing that the reaction in bond yields and the reaction in the S&P. So S&P, when he started speaking, particularly when he ramped up his fairly assertive speech, and we'll get that in a minute, fell off quite heavily. And the reason the blue line is moving up is that's actually bond yields. So bond market was sold off, equity market was sold off, expectations of rate rises not only built but strengthened quite strongly. So all of that you can see in that chart. And that's the interesting thing about this is what did he say? So he was very, very optimistic. In fact, more optimistic than I think the market had been expecting. A lot of people had expected him to be a Janet Yellen light, maybe even slightly Janet Yellen dovish, which is a hard thing to say considering she was anyway. But he came out there quite strongly and said, growth is good. Growth is we're quite optimistic about growth. Inflation is going to materialise towards our long-term target sometime in the next 2 years. We're very, very comfortable with how employment is moving. It was all very optimistic. It was also very interesting to see a candidate that had been put up by President Trump very much single out fiscal policy. You do not normally see a Fed chair cross the barrier and talk about fiscal policy over monetary policy. But he did clearly state that fiscal policy is quite stimulative. It's expected to really ramp up growth over the next 2 to 4 years.
We're talking about the tax cuts, obviously.
Yep, tax cuts is part of it. So that 1.5 trillion US dollars tax cuts. Talking about the new breaking of the debt ceiling, so the $300 billion of additional funding going into the market as well. And then Trump's additional infrastructure spending, which is also 1.5 trillion US dollars. That's a heck of a lot of stimulus going into an economy that's chugging along quite nicely. The question that basically the market's been raising is, does that redline demand? Does that just basically chump up everything? Consumption ramps up, pushes growth through the roof, and therefore monetary policy does have to step in faster and stronger and harder to slow it down. And that's what the market took out of last night, is that 3 rate rises was forecasted by the dot plots, looks incredibly likely. The market is now asking big questions about 4.
Yeah,
and
I saw that.
And that's the question now, is that would mean that March, June, September, and December, they're the reasons I highlight them, they're the press conference months, so the months that they normally sit in front of a Senate committee or sit in front of a testimony and actually explain why the FOMC did what they did. So we are, 18 days? Yes, 18 days away from the first major FOMC rate decision meeting, which is on the 16th and 17th of the coming month in March. There is now basically a factored in 100% chance of the target rate moving 25 basis points with what he said. Not only that, it'll be the first time that we actually get to see the new rejigged FOMC putting out new dot plots, and that will give you that idea. So it was quite strong to Congress. And not only that, he then has to go to the Senate tomorrow night on Thursday, and that will be stronger because the Senate is like our upper house. It is a little bit more open. There will be independent candidates that will actually ask questions. He didn't really get any questions at the congressional testimony. He will at the Senate, and it will be asked: is there 4 rate rises coming? How do you see GDP? What's your expectations of tightening rates and the expectation and cost to the US economy? All of those questions will be in there. And as we saw at the start of this, the market is certainly very much amped up to anything he says.
Yeah, and we've spoken about the return of volatility, but there would be a lot of people concerned, obviously, about the rapid rise in rates, and especially borrowers over there. So it's always two-sided.
Yep.
That there's positives out of this in the sense that rising rates mean the economy's growing strongly, and a lot of good things on the horizon, but for borrowers and the like, it's not a good thing.
It's not a good thing. It's just a natural thing that has to happen inside economies and has to happen inside markets. So, yeah, it's an interesting one, is that when you have growth moving at a really good clip and you have inflation moving at a really good clip, you do have to moderate it because you can get overheating. As they're also pointing out, going back to the whole situation with President Trump, is that you have to go back to basically LBJ and going back to what Lyndon Dunn did when he had unemployment at 4 and a bit %, They were coming along, and he then put a huge amount of stimulus into their market and really, ramped it up. And then the 70s came, and we saw huge inflation issues and blah blah blah, like we saw here in Australia. So that's all part of the question in the US. It does slow down borrowing, but if you look at the US housing market, if you look at US borrowing, even with the current rates, the wealth effect and the growth now in wages is actually being able to soak that up. So it hasn't seen a dynamic, a volatile spike or slowdown, in housing. That would be a signal. It will, in what is a more liquid markets, equities, bonds, currencies, you will see violent reactions, and then you will see a bit of volatility. Whether or not it's as strong as what we saw on February 5th, I don't think you will. I think the market is now just more attuned to the fact that things are changing. The years of 2010 really to 2016, 15 really, are probably over, fair enough, because things have grown. Things have been stimulated. There was high amounts of monetary policy accommodation. It did support growth. People did take a little bit more risk to try and keep things moving. And now they're trying to moderate that. That's normal. That's how it should be. But the market was probably a bit too complacent. So there is now much more positioning in volatility. There is much more positioning in people having put protection. All that's fine. It just means that, yes, there will be a little bit more spikes in terms of volatility. It might mean an equity market has a 1% day off instead of what we've been used to over the last 6 to probably even as much as 9 months, where a 1% downside move has been very, very rare. So, unfortunately, markets have slightly short-term memories and forget about, 2010, 11 and 2012 and the volatility we saw in 2013 when China sort of had a little bit of bit of a wobble. It's just normal market behaviour.
That's definitely the score.
Yeah.
Thanks very much, Evan.
Thanks, Tony.
We'll talk to you next time on The Economic View.